stocks retreat from record highs as investors brace for crucial U.S. inflation report. Imagine the global stock markets hitting new peaks, only to pull back just before a pivotal economic report that could reshape the financial landscape. That's exactly what happened recently, as shares slipped from their record highs ahead of the much-anticipated U.S. inflation data, which will heavily influence the Federal Reserve's next moves on interest rates. On a typical day in Tokyo, a woman walked past an electronic board displaying Asian stock index prices, a snapshot of the global market's pulse. This scene underscores the interconnectedness of markets worldwide, where developments in one region ripple across continents. After a strong month for global equities, largely driven by technology stocks, investors found themselves cautious. This hesitation comes amid growing concerns in the bond markets and political turbulence, including U.S. President Donald Trump's controversial decision to dismiss Federal Reserve policymaker Lisa Cook, and escalating political instability in France. European markets reflected this unease. The Stoxx 600 index, a broad measure of European shares, along with the euro currency, both edged lower, heading toward their first weekly losses in a month. Notably, France's CAC 40 and Germany's DAX indices each dropped by about 0.6%, setting them up for unexpected monthly declines despite the broader positive trend. Michael Metcalf, State Street's head of global macro strategy, pointed out that political risk is making a comeback after a period when international investors were confidently pouring money into Europe. He posed a critical question. Should investors worry more about fiscal risks in the Eurozone or the potential erosion of Federal Reserve independence in the U.S.? This week, he suggests, the answer is a tie. Adding to the tension, yields on key European 30-year government bonds are poised for their largest monthly increases since March. France is at the center of this bond market volatility, as Prime Minister François Bayrou has called for a confidence vote scheduled for September 8. A vote many expect he might lose. This political uncertainty has caused the spread between French and German 10-year government debt to widen significantly, reaching 78 basis points after a sharp rise over the past 2 weeks. Meanwhile, in the UK, bank shares fell by 1.4%, following a report from a prominent think tank suggesting the government might start taxing banks based on their reserves held at the Bank of England. This proposal has sparked debate about the future regulatory environment for financial institutions. Turning to Asia, the picture was mixed overnight. Chinese stocks, measured by the CSI 300 index, enjoyed their best monthly performance in nearly a year, surging over 10%. This optimism is fueled by hopes that China's economy, particularly its technology sector, is gaining momentum. However, Japan's Nikkei index closed lower on the day, despite a solid 4% gain in August. Both the Nikkei and MSCI's broad Asia-Pacific index, excluding Japan, are riding a 5-month streak of gains, highlighting regional resilience. Not all was smooth sailing in China's tech space. The Star 50 index, which tracks technology-focused companies, pulled back 1.7% after a strong 7% rally the previous day. Chipmaker Cambricon Technologies saw its shares plunge over 6% following a risk alert to investors, warning of potential volatility after a rapid price surge since late July. Frank Benzimra, head of Asia Equity Strategy at Société Générale, noted that such sharp moves followed by company warnings often indicate the market may have overreacted. All eyes are now on the U.S. Personal Consumption Expenditures PCE price index, the Federal Reserve's preferred inflation gauge, set to be released later today. Kun Go, head of Asia research at ANZ, emphasized that this data, along with upcoming payroll figures and the Consumer Price Index, CPI, will be critical in shaping expectations ahead of the Federal Open Market Committee, FOMC, meeting in September. Currently, traders are pricing in an 85% probability of a rate cut by the Fed in September, a significant jump from 63% just a month ago, according to the CME FedWatch tool. Fed Governor Christopher Waller recently expressed his desire to begin cutting interest rates next month and expects multiple reductions to bring policy rates closer to a neutral stance. This growing anticipation of rate cuts has pressured the U.S. dollar, which is on track for a 2% monthly decline against a basket of currencies. The euro slipped 0.1% to $1.16.77, weighed down partly by France's political and fiscal uncertainties, while the British pound eased 0.2% to $1.34.77, but is still poised for a monthly gain exceeding 2%. The dollar's struggles are compounded by concerns over the Federal Reserve's independence, as President Trump intensifies efforts to influence monetary policy, including his latest attempt to remove Fed Governor Lisa Cook. Cook has responded by filing a lawsuit, asserting that the president lacks the authority to dismiss her, setting the stage for a legal showdown. Elsewhere in commodities, oil prices dipped, with Brent crude futures falling 0.6% to $68.20 per barrel, and U.S. crude slipping to $64.21. Safe haven assets like gold also edged lower by 0.2% to $3,408.78 an ounce, while Bitcoin dropped 2% to just below $110,000. This complex mix of economic data, political drama, and market reactions raises important questions. How much should investors weigh political risks versus economic fundamentals? Is the Federal Reserve's independence truly under threat? And what would that mean for global markets? We invite you to share your thoughts. Do you agree with the market's cautious stance, or is this pullback an overreaction? Join the conversation below. Additional reporting by Ray Wee in Singapore. Editing by William McLean. Mark Jones is a senior global markets correspondent based in London, specializing in economics, central banks, policymakers, and crises. His experience includes covering the European Central Bank during the Eurozone crisis and UK companies during the early global financial crash. He began his Reuters career on the sports desk, reporting on everything from soccer to cycling.